Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. Joining me today, I have Phil Kosmala with Taiber Kosmala. He is the managing partner and chief strategist. Taiber Kosmala has $12 billion money under management. They work with pensions, foundations, endowments, that was the other one I was looking for, as well as a select group of investment advisors from around the country. Really pleased to have and honored to have Phil on with us today. Great insights, Phil. I want to talk, on the 7 questions, the first one being, how long can this last? I mean, this is one of the big ones, of course. We came out of the longest bull market in history into one of the briefest bear markets ever, into now, I think, 21 months into this bull market. And, of course, as we've talked about, if it's just the economy, if it's just things without the Fed right now having to do what they're going to have to do, we're in sounds like pretty solid ground. But the big wild card here is going to be the Fed. So what do you say? How long can this last? What do you think?
Yeah, Hank, I think the one thing we know from studying history is that if the Federal Reserve goes through a very slow tightening cycle, this may look like the 1990s again. Yeah. And back-to-back 20% years followed by 3 additional years of really good returns. And then ultimately the Fed had to start tightening more aggressively in 2000, and then we had the dot-com bust, and unfortunately followed by 9/11, and that was a horrible recession and horrible bear market. So I think we're looking back in the annals of time and saying we're pretty young into this bull market, Hank. We're 21 months in. The average is 60 months for a bull market. We're at 108% advance off the bottom, off the March 23rd lows of 2000 when the pandemic hit our shores. And the average bull market is 178% going back to World War II. So we do have a little bit more room as long as the Fed doesn't make a policy error here. And I think the Fed's quick reversals over the past month and a half on how they're going to handle monetary policy, conflicting signals from the Fed. Hank, we talk about this all the time. The markets hate uncertainty. Right. And we haven't had uncertainty for a year and a half, despite the pandemic raging around the globe. We've had a lot of continuity in terms of monetary and fiscal policy. And as a result, the stock market has doubled in a very short period of time. In fact, it's the fastest double in the history of the S&P 500. And so you get a pretty unique perspective here in time, or unique window in time. Where
when you look at the valuation Phil, at the valuation and then the mega caps growth in with that, in the context of what you're saying, how does that bear? Or what bearing might it have?
I think it has a big bearing. When you buy stocks at high price to earnings multiples, or you walk in paying a price for anything, your expectations for returns over the next couple of years are historically have been much lower. We're at 21 times earnings on the S&P 500, but those top 10 names, Hank, are still trading close to 40 times earnings. And so you've got parts of the market that are extremely expensive, and parts of the market that look statistically very inexpensive or cheap. And why do you want to buy cheaper stocks at this point in the cycle? Is the market's looking for stability, durability of earnings, and durability of a business model. And you have that downside cushion. There's just less room to fall when you have stocks that are trading at lower price to earnings multiples. So we think there's a good rotation, and that's going to be one of the big themes for calendar 2022, is the things that have been performed as well the last 7 years are due for a comeback, due for some mean reversion. And we think that's going to be something to reposition portfolios according to those themes.
Okay, now question number 2, midterm elections and how they might impact us this year.
Yeah, I think one thing we know, the average downside in a given calendar year is approximately 11%. The markets on average decline by 11% a year. That's almost doubled in a midterm election year. And back to what I said a second ago, Hank, is that the markets hate uncertainty. Midterm election years cause uncertainty. And I think what we're seeing at least is, you combine this back-to-back 20% years, uncertainty surrounding the virus, uncertainty surrounding the Fed, then you throw a midterm election year into the cycle, and it just lends to a higher probability of additional volatility after last year's extremely benign year. Hank, the drawdown last year, the max drawdown was 5%. That's one of the least volatile years in the history of our stock market. So we're probably due for some reversion in terms of volatility. And when you shake all those things together, the confluence of all 3 of those factors, midterm election, virus uncertainty, Fed uncertainty, that just leads to a higher probability for a more choppy path than we've seen over the past year and a half.
And this is one of the things, it's not, as we've said, if you want to stay ahead of inflation, plus cover, of course, the taxes you're going to be paying on those retirement dollars when you start taking them out of the retirement accounts, you have to invest in such a way. You can't just park it in the bank, unfortunately. Fixed accounts are not paying anything. They're not going to stay ahead of inflation and taxes, certainly not likely anyway. Stocks have been the way to go there, and utilizing the fixed side simply to try to manage the volatility somewhat in the process. So when you look at that, with it's not a matter of whether to, because this is one of the concerns. I had a client in just earlier this week, and they're like, well, should I sit out? You know, if there's all these headwinds, all these things that are going to potentially be negative for the market, and it's going to be very volatile and choppy, and do you think it's going to end up positive or negative for the year, and who knows, and you know, should I sit this one out for a while? And of course, this is one of the areas that when you're sitting out, you're actually losing purchasing power, so you have to stay invested. But as you said, it's a time to maybe reassess what you're invested in.
Yeah, Hank, I think that we call that finance the real rate of return on investments. And if money market funds are earning 7 basis points nationally, so that's 0.07%. And to put that in a little bit of historical perspective, Hank, your average money market yields have been about 3.5% to 4% for the past 30 years. And so to have a yield of 0.07%, and you layer on top of that 7% inflation, unfortunately, the Fed cutting interest rates to 0 in the midst of this pandemic, the Fed declared war on savers. And that means it's a much more difficult endeavor for those that sit in cash. You're right, Hank, they're eroding purchasing power. You look at meat, poultry, eggs, auto prices, rental incomes are up 18%, house prices are up 18% year over year. When you take a look at all that, if you sit in cash, it's a tax. It's a tax, unfortunately, on those savers that are trying to preserve capital. And then the flip side of that, Hank, is you look at the bond market. And going back to 1900, bonds have given you a return of about 5%. The worst case scenario that we've seen until this pandemic was 10-year bond yields were at 1.36% in the middle of World War II when Hitler was bombing Britain and marching through France. And so we're sitting here at 170 today. We're almost at World War II levels on bond yields. Right. And that means when you factor in the 7% inflation, even if you're clipping a coupon in a bond portfolio, you've got price volatility, but more importantly, you're eroding purchasing power by about 5% a year. Mm-hmm. And so it's a very difficult endeavor. We think you need to be more active with portfolios when you have this unique environment, this unique starting point that we're seeing at this point in time.
And one of the questions that you have here too is, you know, that I thought was really good, and we've been talking about, you know, again, it keeps coming back to, it's like we've got really good indicators for the most part. Choppiness aside, volatility doesn't necessarily indicate that we're going to end up in a negative for the year. We're not sure, of course, and there's so many different factors to consider for that. And of course, one of them we've been touching on is the Fed. This is the biggest wild card, it seems, of all the wild cards that are in here. And, you know, are they behind the curve, and what are they going to do about it?
Yeah, and Hank, I think it's unequivocal yes on the fact that they're behind the curve. We're still doing quantitative easing right now with 7% inflation. And that means the Fed's continuing to conjure money out of thin air to help finance our deficit spending as a nation. And so the Fed's behind the curve, and I think they're acknowledging that. But the reason the markets have been choppy the last 6 weeks after a phenomenal year in calendar 2021, the reason we're seeing some of this choppiness is in December, the chairman of the Federal Reserve, Jerome Powell, made a proclamation in front of Congress that this inflation isn't transitory, effectively saying we've got it wrong, or we had it wrong. So they're behind the curve, Hank, and I think the one thing that we're going to be watching is the pace of the tightening, or the pace of the rise of interest rates will ultimately dictate what markets do this year. If it's a slow, steady pace, we'd anticipate all those great economic factors that we've talked about on the show today to help propel equity market prices higher.
This is one of those areas too, Phil, when we're talking about, you know, again, we're not sure what the Fed's going to do, which direction they're going to go, but we got to be poised and positioned to be able to protect ourselves if it leads to a bigger downturn than anticipated. So this, we'll talk about some strategies. In fact, one that you helped with, your firm and Virtue developed the stop loss overlay. So maybe this is another way to protect yourself, another strategy to give you a bit of a safety net over what might happen, where you can still stay invested, still be seeking those returns that needed rate of return to accomplish your financial goals, but yet give you some downside protection. Do you think this is an even better time, in fact, to have that, to apply that strategy than in the past?
Yeah, I do, Hank. I think anytime you get this level of uncertainty, the past 20 months have been really easy. Seems like it hasn't been easy with Delta, then Omicron, and supply chain issues. But the $12 trillion that was jammed into our financial system, combined with the healthy risk appetite that we saw, we felt pretty good the last 20 months with just a long-only position of buy and hold. But we're in a much, much more difficult position right now with the Fed already announcing that they're changing, that they made a mistake, that policy's been too easy for too long, and that they're having a hard time explaining some of these inflationary pressures. We think it's imperative to have that stop loss strategy or some sort of defensive technique. Should the Fed make a mistake, Hank, we're going to have to get to the sideline. And I think having that discipline in place to take the fear and emotion out of that decision is imperative as we walk into this calendar year 2022.
One of the things too, Phil, you talked about, we were a little bit about inflation, because this is a big one in the news. They just announced again, what was it, 7%, gone up a little bit to 7% now. You mentioned about car inventories as far as the supply chain and the impact there. And we're seeing, so with the supply chain aggravating these things, and the fact that, just like we were talking about with cars, when you have such a small inventory relative to historic inventories anyway, this typical just supply and demand, and in this situation when supply is so sparse, we're seeing, like cars where it's not, it's more about, can I get a car kind of thing. If I want a new car, you're negotiating how much over sticker you're going to pay versus how much in the past, how much maybe over invoice that you might cost that you would be paying. So quite the change there. How do you see inflation and the impact here in particular do you think it's get resolved this year? Do you think it maybe carries into next year?
Hank, I think some of the supply chain issues will get resolved by the end of the year. But the administration and some of the economists in the administration have been saying that we'll have these supply chain issues rectified by mid-year. And Hank, we're looking at shipping data very closely. And I think watching how many ships are sitting outside of Long Beach, the Port of LA, Port of Vancouver, looking out in New York. And unfortunately, Hank, we're playing accounting gimmick games here. What they're doing is they're moving the ships more than 40 miles offshore. And so what that does is it makes it look like we don't have as many ships waiting to dock. But the inflation outlook is probably going to stay sticky for a long time. It's not going to stay at 7, though, Hank. I think by the end of this year, we're probably down with a 4 handle on inflation, but that's still way above what we've seen for the past 40 years.
Yeah.
But yeah, I think the last thing on inflation, Hank, is part of the answer to forecast for inflation this year is unfortunately the path of COVID. And you think of like throwing a pebble in a pond, ripple effects. When you see Southeast Asia start to get case counts jumping like they are right now, you look at China and other parts of Southeast Asia, Hong Kong, et cetera. When you see case counts jump, that means that you have spacing and social distancing issues in chip fabrication plants. So, and then on ports, to get those ports moving from Southeast Asia to ship them back to the United States, you see slowdowns in deliveries. Then they get here, and the ships can't get into dock. They can't get enough truck drivers to come in to take the material off of the ships and move to various parts of the United States. I think this inflation is going to be with us longer than the Federal Reserve thinks right now.
Not all good news, but this is probably one of the most important parts and lessons to take from today is we need to be thinking in terms of what's coming, not what's been. We've had a really great run. Now we need to be thinking, how can we preserve those gains, protect ourselves while still seeking to get the market returns that we're going to need. All right, we're going to take another break. When we come back, join us here. We'll be right back on the Retirement Report.